So we're talking about sensitivity analysis. And so, just like I was saying that you can buy a machine, that machine will be able to cost you some amount of money. Now, we are looking at how the profit will behave. How sensitive is the profit vis-a-vis other variables? So we look at the changes in the net present value, which we said yesterday that net present value is like the profit. If you increase the cost of that machine, will you gain something? If you increase the price of the product that you are selling, will you gain something? How sensitive is the profit vis-a-vis the cost of raw material, the cost of buying the machine, that is the initial cost, and even the cost, and even the price, unit price, or quantity. So that means that ordinarily, when you want to look at profit, we normally say that profit is equal to the price minus a cost, that is variable cost, price minus variable cost times quantity minus the fixed cost. That is what profit is. Now, how sensitive is the profit when you vary the fixed cost? And fixed costs are things that you have to pay. They do not depend on the price. Like now, the amount that we pay our lecturers here, we pay them whether you're only 3 students or whether you are 100 students, we pay the same amount. Now, that is fixed cost. Now, that fixed cost does not depend on the number of students. So, how sensitive is it? Is the profit when we increase the teacher's salary, maybe from 2,000 per lesson to 2,500? How sensitive is it when we increase the price per unit? Right now, we are charging maybe something like 4,500. What if we increase it to 5,000? Or we reduce it back to 4,000 and offer it? How will the profit behave? That is now what we call sensitivity analysis. We are trying to analyze the effective change on the profit, or what we call the net present value, as a result of the changes on these other variables. The variables are these. These are variables because they have an impact on the profit. So a change on these can bring a change on the profit. So it is the profit that is constant, right? But the variables can change. So the subject matter here is the profit, which now the result of this depends on these ones, the behavior. I hope that is good. Now, there are 2 ways of understanding the changes. The first one is called impact analysis. Under impact analysis, impact sensitivity analysis, we are looking at the percentage change. So we say, if I change the profits by 20%, what will be the change? If I change the price, either adversely, downwards, or positively, that is favorable, by 20%, what will be the impact on the profit? Whenever you're given the percentage change, listen, when you are given the percentage change, then that one now we call it the impact analysis. In some cases, the examiner might not give you the percentage change. If the examiner has not given you the percentage change, then that is called break-even sensitivity analysis. So we have 2 types of sensitivity analysis, right? Now, I want to write something so that you can be able to remember and even understand what I'm saying better. You can say, right with me, that sensitivity analysis, and then you say that the focus in this case, remember this one is number 2. The first one under capital budgeting, yesterday we handled simulation, and today we are now looking at the sensitivity. You say that the focus in this case is to determine the effective on net present value. The effect on net present value. The focus in this case is to determine the effect on net present value. The focus in this case is to determine the effect on net present value. So net present value is like profit. So you're trying to look at the effect on profit. That is the effect on net present value due to a change in a given variable. due to a change in a given variable. So these are the variables. And whenever you're changing the variables, let the rest remain constant. You change variable one at a time. You don't change all of them at the same time. So if you are talking about the impact of fixed deposit change or fixed cost change on the profit, you let the other variables remain constant so that you vary them one at a time, right? When you look at the percentage change of profit, kindly let the other on the price, let the other variables remain constant. And so we are saying that it focuses on the determination of the effectiveness or effective, it is the focus in this case is to determine the effect on net present value due to a change in a given variable, holding other factors constant. Holding other factors constant. A change in a given variable, holding other factors constant. Holding other factors constant. Na kama umefika hapo na umeelewa, please let me know. Say proceed. If you want me to repeat, you can say. Sasa. So the change effect on NPV due to a change in a given variable, holding other factors constant. Holding other factors constant. Are we together? We can proceed. Sally, Faith, are you guys okay? So welcome, Mark. My name is 𝗪𝗲 Dennis, and I like teaching FM. So feel free, you can join us. We only charge 4,000 per unit. We can proceed. You can say that other factors remain constant, i.e., variables are changed one at a time. I.e., variables are changed one at a time. 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 One at a time. Fine. So that is quite good. You say that there are two types of sensitivity analysis. 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 Number A, impact analysis. There are two types of sensitivity analysis. Then you say A, impact analysis. Here you say that percentage of variance is given in advance. Percentage of variance is given in advance. Percentage of variance is given in advance. So that is what can help you to know. It is not easy to solve a question in FM when you don't know what they are asking. Like in this case, we are looking at the percentage change, but we are now looking at it under sensitivity analysis. So whenever the examiner has given you the percentage change, then that is called the impact analysis. Kama hujapewa, the examiner wants you to look at the sensitivity analysis, but you are not given this percentage change, then that is called break-even point sensitivity analysis. So that is number B. Break-even point sensitivity analysis. So in this one, you say that percentage of variation, the percentage of variation is not given. Percentage of variation is not given. Let me show you an example. We are not solving it, but I want to show you so that you can see. If you can really understand, if you are really understanding what I'm saying, I want to test. Who can share the past paper question? Nani akona past paper questions? We look at 2019, I think November or something. So that you can understand the language. Who can share? AFM past paper questions. AFM past paper questions. So look at our WhatsApp. I've shared it on the WhatsApp group. I've shared it on WhatsApp group. Check our WhatsApp. Umeiona? Nobody has confirmed if you are seeing. Can somebody confirm that you are seeing them? Which year? 2019. 2019 November. I'm trying to share on the screen. That is what I'm doing. Let me see. I've seen question number B. I think now I have it, I can share. It's 2018, so we have 2019. May. You're seeing this one, number 1B. Can somebody read it for us? It's number 1B. You can read it. So the question says that 𝗪𝐶𝐺 Technologies is considering investing shillings 50 million in a new machine to manufacture computer microchips with an expected useful life of 5 years and no salvage value. It is expected that 20 million units of microchips will be sold each year at Kenya shillings 3 bob per unit. Variable production costs are expected to be 1.65 per unit, while incremental fixed cost will be 10 million per annum. The cost of capital is 12%. Evaluate the sensitivity of the project, net present value, to the following changes. So when there is a change in sales volume, when there is a change in sales price, and the variable cost, which kind of sensitivity is that? That is what I wanted you to test. You are not able to unmute. Oh, sorry. Let me unmute you guys so that you can talk. Just make sure that your background is clear. Okay. You can ask questions now. So which kind of sensitivity is that? Which type
impact?
Of, is it impact or break-even? Look at the question carefully, then tell me with a reason why you think it is impact or why you think it is break-even. Just go through it, then you can tell me the reason. That is what examiners do. They will set a question and then you start wondering. You know it is sensitivity because they are mentioned. Sometimes they don't even mention that it is sensitivity. It is you to know.
Okay, I thought it was impact because of the variable production cost, or it has to be in percentage.
So you are saying it is which one?
I said it was impact because
It is
of
impact.
we are given the variable production cost, or it has to be in percentage, the variance.
Yes, it has to be percentage. We say that the only way
Okay.
you know is under impact, you must be given the percentage of variance. You'll be told that when the sales volume varies by 20%.
Oh, okay.
Percentage.
Mm.
Yes. Like this one now they are silent. So if they are silent, that is now
break even.
Break even. Sasa.
Okay.
In impact, they have to tell you. They will tell you that the variable cost, this one has changed by 10%. Adversely or favorably. Okay, now I want us now to look at impact analysis. We start with that. Now let's start by looking at the impact analysis. Impact sensitivity analysis. I want to say that it seeks to answer the question, it seeks to answer the question, what is the percentage change? It seeks to answer the question. It seeks to answer the question, what is the percentage change? What is the percentage change of NPV as a result of a given change in a key variable? What is the percentage change of NPV as a result of change in a key variable? So we say that it seeks to answer the question, what is the percentage change of NPV? What is the percentage change of NPV as a result of a given change in a key variable? What is the percentage change on NPV as a result of a given change in a key variable? So let's look at an illustration. So assuming that we have revenue, example, assume that we have revenue, and the revenue is revenue per annum is something like 10,000. Then we have cost per annum. Also, we have 6,000. Then we have the cost of capital, which we shall be writing as COC, is given as 10%. Then you are given the number of years. Number of years is 5 years. And then you have initial outlay. which we call IO, as 4,500. 4,500. Required. Determine the NPV of the project. 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 Determine NPV of the project. Number 2, carry out sensitivity analysis. Carry out sensitivity analysis. Carry out sensitivity analysis. If revenue and cost are varied adversely by 10%. Carry out sensitivity analysis. Carry out sensitivity analysis if revenue and cost are varied adversely by 10%. Now we said that NPV is normally like a profit. So let's have the solution. Let's have the solution. So we can make it look like a profit, and we say that profit is normally revenue minus cost, right? Profit is basically revenue minus cost. Profit is normally revenue minus cost. So what is the profit here? We have 10,000 minus cost, which is 6,000. We shall have our profit as 4,000. But we need to discount it, right? For NPV, we have to discount that profit. Profit is the cash flow. That is money that has come in. The amount that we normally discount must be the free cash flow. Therefore, our free cash flow is normally profit minus all expenses. All expenses. So this one is the same as profit before depreciation and tax, which is 4,000. In normal times, from this profit in your business, you took the total revenue that you got, that is the money that came in, minus cost, you get a profit. You need to deduct all expenses. One of them is depreciation, so you less depreciation, and then you tax. Now, listen carefully. We might find a situation like this, where you are given a depreciation of the machine. You know, the value of machine goes down with time because depreciation happens, and you are given tax. Where there is tax, then depreciation is relevant. Tunaelewana? Wakati umepewa tax that the company uses corporate tax of 30%, then now you have to calculate depreciation kama umepewa depreciation. Or the best way to calculate depreciation, in fact, examiner will tell you that is on straight line. This is the cost of buying the machine, and the machine will stay for 5 years. So every year it depreciates at a constant rate of 900. So depreciation is normally 4,500 all over 5. So that is the depreciation per annum. 4,500. That is the depreciation per annum. Now, if you are given percentage on tax, then it is important now to use depreciation or calculate depreciation. Why? Because depreciation is normally there to help us know the amount that is taxable. And then you add it back. So, listen, in case, this is where you are, profit before depreciation and tax, right? And then you are given that there is a tax rate of 30%. You want to look at the free cash flow so that you can know your NPV. 30% you need to calculate. The machine could have lived, it can live for 5 years without any residual value, meaning that at the end of 5 years, it is zero residue. You cannot resell it. So it will be totally depreciated. Therefore, you now come from here and say that less depreciation. I want you to write this somewhere for future reference, it will help you. Less depreciation, which is, let's say that is 900. So 900 according to this one can be 900. So if you less 900 from 4,000, what will be profit before tax? We have profit before tax because to share toward depreciation, so to back in a tax. It will be 4,000 minus 900, and that gives you 3,100. Now less tax. I'm saying that this one is applicable where the examiner has given you the rate of depreciation or depreciation amount, or they have mentioned that depreciation is on state line. And the examiner has also given you tax. If there is no tax, don't worry. Without tax, you don't have to go through this. But if they give you tax, then you need to calculate from profit that you normally get, kawaida, you minus depreciation, then now less tax. Tax is 30% of this, so you say 30% of 3,100, and that will be how much? 93,930. Is it? $930. Now, when you less 930 from this, so it is 3,100 minus 930. What do you get? That will now then be the profit after tax. Profit after tax, which you call PAT. Profit after tax will be that. What is the figure? What will be the figure? Profit after tax?
21,770.
21,70. So this profit after tax, what we are looking at here, I want you to listen carefully and understand. When you are getting NPV, you are supposed to discount free cash flow, meaning that it is the cash flow after paying everything, including tax. So because we want that cash flow, we want it, we need to ask ourselves, now that we have been given tax, how much did we pay as tax? Tutoe pesa ya government iende, tubaki na pesa yetu. That is now what we call free cash flow. It is a free cash flow that is used to discount, that is used to calculate NPV. Sawa. So when you are given information, the first thing that should disturb your mind, from this information, how do I know the free cash flow? So because we have the profit, we can calculate. Then we know that now we've been told that there is tax. You now need to deduct that tax. And the only way you can deduct tax is after deducting depreciation. So unatoa hiyo depreciation kwanza to allow you now calculate tax. That's why we are saying that whenever tax is given, then depreciation is now relevant. If there is no tax, depreciation is irrelevant. Yani haijali. Haina haja calculate. Kwa sababu it is not going to help you calculate any tax. So depreciation is not actual money that has left. We are talking about flow of money, cash flow, pesa yenye imetoka. So depreciation is just an imaginary figure that we normally use, but it's not actual money that has left the account. So it helps us to calculate the tax, alafu tunalipa hiyo tax. Ile pesa tumebaki nayo after paying the tax, you add back depreciation, because even though we deducted depreciation, there was no money that left our account. Tulitoa kwa sababu tunataka calculate tax, lakini ideally there is no money that left our account. So it is cash that is still there in the bank. We use it to calculate, tukapata 930 peke yake ndio tulitoa tukalipa serikali. But the balance remains. So how do I know the balance that is in the account? We add back the amount that we removed or we deducted at depreciation. So we say up to here, you now add back depreciation. You to do the actual money that you have in the account. That is now the free cash flow. It is cash flow that has not been spent. So add back. After getting profit after tax, now add back depreciation that you took, the one that you actually deducted. So you add back depreciation, that is 930, no 900. You add it to the 270. So that now gives you the free cash flow, which is now 3070. That is now the cash flow that we can now use to calculate. Remember, when we're saying present value is normally the free cash flow times discounting factor. Now, this is now what we call free cash flow because haina baggage at all. We have deducted everything. We now remain with the amount in the account. You can now discount it to get your NPV. Only when you are given the tax rate. If you are given tax rate, that is when you now work with depreciation. If the examiner has not given you tax, it means that the full amount that we had here all went to our account. Hakuna pesa tulipoteza. Kwa hivyo kama hakuna tax, then the profit before depreciation is the same as the free cash flow. Profit before depreciation is similar to the free cash flow. Now, again, let's see. Sometimes the examiner can tell you that it is the policy of the company to always set some money aside for future use. Maybe they want to have some development, what we call in finance or in accounting, capital reserve. Yani kuna pesa wanatenga kando, ili ile machine ikizeeka wanaweza tumia hiyo pesa. So it is a rule. Ukipata pesa kwa account, they chop their money, they keep aside. So that amount you can be told that is the amount that they normally keep aside. If they tell you like that, then before you come to this free cash flow, deduct that amount. After calculating this, deduct that amount. Whatever will remain is now the free amount. Because if it is inside there, then we cannot assume that the whole amount is free. No, it is not all free. Part of it needs to be saved. Ndio watatumia kununua machine in the future. Are we together? So in this case, we don't have depreciation and we don't have tax in this particular example. So we are taking this as our free cash flow. They didn't even tell us that they are setting aside some money for future expansion. So the 4,000 is now our free cash flow because there is no depreciation and there is no tax. Depreciation is irrelevant if there is no tax. It is not making sense when there is no tax because it does not help you anywhere.